What do we know about financial theories? This video explores the strategic financial management landscape. We'll delve into key theories shaping corporate finance. What should be the goal of a corporation? Is it maximizing profit, minimizing costs, or increasing market share? The focus is on maximizing the current value per share of existing stock. Alternatively, maximizing the market value of the existing owner's equity. This chapter explores these fundamental objectives. The Balanced Scorecard offers a comprehensive view of organizational performance. It integrates financial and non-financial measures. This tool supports strategic planning and management. By balancing different perspectives, it aligns business activities with the vision and strategy. It ensures that the corporation's goals are consistently met. David Durand introduced the net income theory. It suggests increasing the firm's value by maximizing debt in its capital structure. Debt is cheaper due to lower interest rates compared to dividends. The tax benefit further reduces the cost of debt. This theory is also known as the fixed key theory. The total value of a firm is calculated as the sum of shares and debt. The market value of shares is derived from earnings available for equity shareholders. Debt is valued at its face value. The overall cost of capital is computed using the firm's earnings before interest and taxes. This forms the basis for financial decision-making. David Durand also proposed the net operating income theory. It claims the firm's total market value remains unaffected by capital structure changes. The overall cost of capital stays constant. The debt-equity mix is irrelevant under this theory. It is often referred to as the irrelevant theory. The theory assumes the division between debt and equity is irrelevant. The market capitalizes the firm's value as a whole. Business risk remains constant at all debt-equity levels. Overall cost of capital does not change. Corporate income tax is not considered in this theory. Market value of equity capital is calculated by subtracting debt from the firm's total value. The cost of equity capital considers earnings minus interest on debt. This is crucial for evaluating investment decisions. Understanding these calculations aids in strategic financial planning. It ensures optimal capital allocation. Ezra Solomon introduced the traditional theory. It suggests reducing capital cost by increasing debt in the capital structure. Debt is a cheaper source compared to equity capital. This theory outlines 3 stages affecting capital structure. It emphasizes the importance of maintaining an optimal debt level. The first stage involves increasing firm value and reducing capital cost with debt. In the second stage, firm value peaks while capital cost is minimized. The third stage sees a decline in firm value and a rise in capital cost. Understanding these stages aids in strategic capital decisions. It highlights the delicate balance in capital structuring. Franco Modigliani and Merton Miller introduced this influential theory. It examines capital structure in the absence and presence of corporate taxes. Initially, they argued that firm value is independent of capital structure. Later, they acknowledged the impact of corporate taxes on firm value. This theory is pivotal in modern financial management. Without corporate taxes, firm value and cost of capital are unaffected by capital structure. Debt-equity mix is irrelevant in determining firm value. Increased debt raises the cost of equity, offsetting debt's low cost. Identical firms with different structures have equal market values. This underscores the theory's foundation. The Modigliani-Miller approach assumes a perfect capital market. It considers no transaction costs and homogeneous risk classes. Expected earnings before interest and taxes have identical risk characteristics. Earnings are fully distributed to shareholders. These assumptions form the basis of the theory. With corporate taxes, the Modigliani-Miller theory's initial argument changes. Firm value increases with more debt in the capital structure. The cost of capital decreases due to tax advantages. Levered firms have higher value compared to unlevered ones. This insight is crucial for strategic financial planning. Changes in capital structure affect the overall cost of capital. Increased debt initially reduces the cost, benefiting the firm. However, beyond a certain point, financial risk rises. This leads to an increase in the cost of capital. Understanding these effects is vital for effective financial management. Arbitrage ensures that two identical firms have equal market values. Differences in capital structure do not affect value due to arbitrage opportunities. Investors exploit price differences to equalize values. This process maintains market efficiency. It supports the Modigliani-Miller theory's assumptions. Risk plays a crucial role in determining capital structure. Firms must balance debt and equity to manage risk effectively. Increased debt raises financial risk, impacting firm value. Proper risk assessment guides strategic financial decisions. It ensures sustainable growth and stability. The market value of debt is crucial for assessing a firm's capital structure. It impacts the overall value and cost of capital. Understanding debt valuation aids in strategic planning. It ensures optimal financial decisions. This knowledge is essential for effective financial management. Debt offers significant tax advantages for firms. Interest payments are tax-deductible, reducing overall tax liability. This benefit lowers the effective cost of debt. It incentivizes firms to use debt in their capital structure. Understanding these benefits is crucial for strategic financial planning. Strategic financial planning involves optimizing capital structure. It requires balancing debt and equity to minimize costs. Effective planning ensures sustainable growth and financial stability. Understanding financial theories aids in making informed decisions. This chapter highlights the importance of strategic planning. In conclusion, understanding key financial theories is essential for making informed and strategic decisions that drive organizational success. Financial theories such as portfolio theory, capital structure theory, and the efficient market hypothesis provide valuable insights into how markets function, how risks can be managed, and how value can be maximized. By applying these principles, financial managers can develop effective investment, financing, and risk management strategies that align with business objectives. A strong grasp of financial theory not only enhances analytical skills, but also supports sound, evidence-based decision-making in a dynamic global economy. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07,484,361,688.